First, it's Friday morning, last trading day of the week. It's a dull start. It's a drabby start, if I may use the word. The breadth is looking even Steven. So traces of profit booking have already kicked in. We've been using the word lazy and choosy. I think today it's going to be lazy and choosy, which really would be at play. 796 advances, 558 decline. Not too many newsmakers actually, but the stocks where quarterly updates have kicked in. Titan, 60 rupees, 62 rupees. Kalyan Jewellers, another big one. 30% is what they've reported. And Dabur, okay, I mean, they'll take some time before markets really, adjust to what is happening there. But what is interesting today, I think, is the small cap index is in the green, whereas large cap stocks are trading with a backseat. Let's look at Suzlon. It's one stock where the move has been extraordinary. No prizes for guessing. Suzlon is not moving higher, and why? But Titan is turning out to be the real star. I want to look at some of the PSU banks also once, because that's where the open interest seems to be shifting. Can Bank, PNB, SBI, and the PSU banking index is also not off to a great start. So a lazy start, Eicher. I mean, I'm not surprised at all.
Yeah, let's just look at some of the other stocks. Let's see what Titan is up to. Remember, they've in their quarterly update indicated a revenue growth of 20% year on year for the first quarter. Dabur, the consolidated business, has grown in excess of 10%, and they are talking about both a rural as well as urban recovery. The stock at least is not falling and trying to nudge up now into the green. Sobha, the Q1 sales value of 1,464 crore rupees is what they've clocked, and that's an uptick of nearly about 28% on a year-on-year basis. 3% higher for Sobha Limited as we speak. I want to see what Reliance as well is up to. The NCLT has approved the demerger of Reliance Strategic Investment, Geo Financial Services. RIL, the big mover from yesterday and the stock which was single-handedly leading the market recovery. Today it's a lot more tempered at 26.45. Aster DM as well. Economic Times reporting that the promoters are initiating a stake sale talk for their India business. So that's another stock which is in focus this morning as well. Cipla, the company has recalled 6 batches of one of their very key drugs. So look out for some sentimental move perhaps in Cipla. That's down about almost 0.5% as we speak. And then Tata Steel as well. The Q1 India business deliveries have come in higher by almost 18%. Although Europe deliveries are down about almost 8% on a year-on-year basis. So flat for Tata Steel as we speak right now. Couple of other names which are in focus. In Praj, news came out just last evening. IOC and Praj are looking to form a joint venture for biofuel production capacities in India. So just look out for what Praj as well does, although it's been a rank sort of non-performer year to date, so to speak. That's pretty much it for the texture of the market. Let's see whether Eicher is falling more and whether there's more traction on M&M, on Tata Motors, Maruti. Eicher finally seems to have at least stalled the fall, but these are again only opening rates. M&M starts off in the green, Tata Motors marginally higher, Maruti at 98.79. What is Apollo Hospitals, what's BPCL, IOC, HP up to? Because energy, remember, has been the leading pocket of late. BPCL again very, very tempered, HPCL up in the green, IOC well in the green, 1.5% or so. Kunal, the much needed pause comes in. What trades do you punch in now?
Yeah, I think on the index front, I would expect a few more days of consolidation. I think one should, as I mentioned earlier, that one should try and drop down the leverage as well as position size and try and take advantage of this correction, if it extends to another couple of days. I think that could be a very good re-entry point for the indices. In terms of opening trade, one of the stock which I think is beaten down significantly is Eicher Motors. And I think now on the daily, more specifically on the hourly charts, the indicators are extremely oversold. So would look to go for a contra buy if the stock drops by another 50 to 70 points.
Naresh, what are the first trades that you're punching in?
So that would be a buy on Bosch Limited. The stock has broken out and still looks interesting in terms of risk reward. Not far away from a 52-week high. So looking at this one as a breakout trade.
All right. Thank you, Kunal and Naresh. Markets, meanwhile, this is the advantage of bull market. Markets will react and overreact to good news. They reacted to the jumbo move in Bajaj Finance, jumbo move in Titan. Both Bajaj Finance and Titan are classic compounders, very expensive by historical yardstick, but when they deliver, markets, they will appreciate that in a tough environment where rural sales are under pressure, where the economy is moving K-shape, all Titan is growing at 20%. Bajaj Finance is growing at 32%. And those stock moves are getting rewarded. And that is what we must recognize and appreciate. The tricky part is that what happens next? I mean, everybody's excited. Everyone is bullish. I've learned one simple line over the years by tracking markets. Good news and good price, it rarely comes together. So are we going through that phase where there is a lot of good news but no good bargains? But where are the bargains in this market? Where is value in this market? Let's take that conversation forward with Krishna Kumar Karwa, Managing Director with MK Global Financial Services. KK, good morning. Thank you for joining us. It's been a heck of a bull market. Do you think this summer rally of 2023 has still some more steam left?
Yeah, I think in the last few months, or rather post-March end, massive rally, yes, because macros were playing out, I think, in terms of inflation, interest rates, etc. All those positives were playing out. And we also saw massive inflows from overseas post the China trade didn't play out the way it should have. So I think that part is done with. Currently, also, macros continue to remain very positive in terms of inflation being under control. Interest rates also expected to be benign, or rather not going up at least. But I think if you look at valuations of individual companies, etc., after the last in the last 3 months, we have seen many of these company valuations. Prices have moved up by say 20%, 30%, etc. So I think the valuation comfort is no longer there. So to answer your question, that from here, what or kind of, my sense is going to become more and more difficult. It's going to be very much bottoms up kind of a market where investors will have to figure out where there is still value left and stay invested in those kind of companies, or look to invest in those kind of companies. But the big momentum has already played out, and there is a fear of missing out kind of, because many people have missed this move also. So to that extent, corrections could be shallow till everybody who left out has not yet got in.
Where is margin of safety, and where do you think market still has some more steam left, where a 15-20% upside or a 10 to 12% upside in large cap stocks is still left in the next 12 to 18 months?
See, I think some of the sectors which in the last 2 years have not done well, and of late, at least valuation seems to be in their favor, and we have seen some move already coming in. So I have been talking about insurance sector for some time, and now it has started playing out, where the margin of safety was very high in terms of the valuations. So that was one segment where we could see. Another segment, I think, which has not done well in the last 12 to 18 months, relatively smaller segment, but again, the whole agrochemical space, for various reasons, including supply chain, overall glut in the overall ecosystem globally, and poor monsoons, etc., overall. But I think the valuations of many of those companies have come down to very attractive levels. So this is where some valuations should favor you. Otherwise, in your banking sector, yes, the smaller banks, I think they do offer you opportunities where valuations are still very reasonable, growth momentum seems to be good. So maybe a catch-up trade could happen over there. But having said that, I think opportunities to invest are becoming very, very limited, because valuations don't seem to be in favor. Most of the run-up has already happened, and wherever there is a momentum, I think stocks are discounting maybe 2 years and 3 years in advance. So I think investors need to be very careful in terms of deploying fresh money. In fact, this could be an opportunity for many investors to look to cash out in segments of the market where the discounting is more than 2 years.
Interesting. You know, KK, similarly wanted to understand, where do you sense that there is now exuberance in the market? Any sectors which you think are overrated at this juncture, and you could burn your hands if you continue to deploy more money or even hold those positions?
Then if you look at the whole, I don't deny the opportunity as far as the defense opportunity is concerned, but look at the valuations of many of those companies. I think there's clearly a sense of exuberance which is prevalent in that segment of the market. So yeah, I mean, you have one buyer and not no guarantee on cash flows for order books and all to value companies based on incoming orders. I don't think so. That's the right way to look at companies. So that's one segment where clearly there seems to be a lot of over exuberance, which we can possibly see. Otherwise, also I think some of these manufacturing, electronic manufacturing, what they call, I think there again valuation seems to be, the opportunity seems to be very good, but the valuations again have gone ahead of the curve. My sense is there should be some correction or some consolidation which should happen. So yeah, I think you'll have to go stock specific, sector specific to come to a conclusion. But you don't find opportunities to buy. Let's put it the other way.
Morning. I also wanted to understand your outlook on the manufacturing sector. Do you believe that there are strong tailwinds going down the line?
So we have been positive on the whole manufacturing opportunity for the last 12 to 18 months, and it has played out well. There are investors have on the overall portfolio made maybe 35 to 40% kind of returns, substantially outperforming the broad indices. So that's a very wide segment. If you look at it, that covers almost say 45 to 50% of the overall market cap. And that includes segments like auto ancillaries, CRAMs, and even pharmaceutical companies, agrochemical companies. So that is a very wide segment, engineering companies, etc. And there the opportunity is right from the local opportunities, the incentives which the government is giving, plus the capex cycle picking up, and the export opportunities, China plus one. So that's a very wide encompassing theme that we are very positive on, where we believe that, and most portfolios, if you look at it, because the indices broadly have say 50-55% kind of exposure to services sector. So inadvertently, I think the investors' exposure to the manufacturing sector is much lower than what it should be. And the kind of trust that the government of India has and the opportunity which the global ecosystem is giving to Indian companies. So my sense is that the whole manufacturing opportunity is a multi-year opportunity, and investors should look to increase their exposure over there. Yes, we have to be careful on valuations. I think that goes without saying. So there will be bouts of exuberance in many sub-segments in this sector. But otherwise, I think the manufacturing opportunity seems to be phenomenal from the next 3 to 5 year perspective.
KK, is there merit in being market cap agnostic right now, or do you think one should be extremely conscious of that? I mean, news coming in this morning or last evening, actually, the two of small cap funds have stopped taking any fresh money in their schemes, a Nippon AMC and a Tata AMC. Now, the reason could be anything. Maybe they feel small caps have run up ahead. There are lack of opportunities right now. Valuations are getting exuberant, within that pocket. Just tentatively, I mean, should one be looking at large caps, or you think that small caps and mid caps will continue to give and generate higher returns from even these levels?
So I think what has happened is, as far as my sense is that this is a very sign of maturity of the mutual fund industry, that they have decided to, some of them have decided to not take money in the small cap fund when the inflows are very robust over there and opportunities to invest is not there. So from a longer term perspective, I think this gives right signals to the investor community that the whole MF industry is not only about gathering AUM, but also giving returns. And having said that, yes, the experience which we have seen in the last 3-4 months in the small cap, mid cap segment does take away good opportunity, or at least there are not too many opportunities to invest in. So, but having said that, I think normally, I think you just go across sectors and invest in companies, opportunities wherever valuations are attractive. And yes, currently it does look like that some of the larger cap companies which have not participated in the market in the last 3-4 months, or maybe even 6 to 9 months, probably the opportunity for investors to put additional money to work would be in the larger cap than in the small mid cap. I think what happens in the small mid cap segment, whenever markets are doing well, investors tend to buy into stories which are 2 years, 3 years, 5 years down the line. And then when markets correct, investors lose interest and stock price correct and they throw in the towel at the wrong time. So to that extent, I think it is important that investors currently, if they want to deploy money, I think they should look to deploy in the larger cap where valuation comfort is there, and be very, very selective in the small mid cap segment where valuations are not giving you any comfort.
Okay, one last question before we let you go. Lots happening within autos. What are you most excited about? Maruti's Invicto, the new Harley Hero X440, or the latest from Bajaj Triumph, Speed 400 or Scrambler 400X?
So my experience suggests, I mean, the way I look at it is that as far as the two-wheeler industry is concerned, I think still it is at 3 to 4 years lower than, I mean, the peak was in March 19. So I think still have some time to go before they cross that peak. So there is a momentum which is there in the two-wheeler segment per se, and some of the stocks should continue to do well. And as far as the four-wheeler segment is concerned, I think whoever has got a good product new products lined up, I think normally they tend to do well. And so wherever you find an opportunity, I think you should be looking. So I'm positive on the four-wheeler four-wheeler segment as well as the two-wheeler segment. I think another opportunity could be to play through the auto dealers. Some of them have got listed, and that will give you an opportunity to take an exposure to a segment of the market which is not available otherwise for public investors. So overall auto segment, yes, it has not delivered great returns over a 3-5 year period, but looks like that the cyclical uptick is on. I would be very careful on the commercial vehicle segment. I think that segment seems to be closer to peak, and investors should be very careful about investing in that segment of the market where valuations also seem to be at a premium to their historical averages.
Okay. All right, KK. Really appreciate your time. Glad you could join us.
Thank you. Thank you very much.
What do we have in markets? Well, we've got a little bit of lazy start. Lazy is the word. Pharma off to a decent start. Autos are okay. But one stock which is galloping, forget about any lazy activities, Maruti. The stock earlier this week touched 10,000. And every time when Shashank is on the show, and if he's joining us in the morning show, we start with this famous quote. The butter from the bread is missing, but when the stock is at 10,000, the butter is toasted, and I think the bread is toasted and toasted from buttered from both the sides. 10,000 rupees stock. Now where is the bread? Where is the butter? Everything is on the table along with the lassi.
It's the cake, I think.
It is, with the cherry called Invicto.
So official guidance from Maruti that the bread, forget about the bread, now it's the cake with the cherry which is back on the table. Can I make that an official guidance from Maruti? Okay. 10,000 rupees for the stock markets are excited about what's happening in the auto space. Let's start with first your understanding of the market, and then we'll get into specifics of your new car launch.
Well, the quarter which just went by, April, May, June, was the highest ever quarter one in the history of Indian auto industry. We saw the highest ever April, highest ever May, highest ever June. Overall, the Q1 numbers were about 9.5% higher than last year. So that's good. And if you look at the January-June period, for the first time, H1 numbers crossed 2 million mark. That's pretty good going, I think, and the demand parameters look quite stable. However, going forward, I think in Q2, you will see lower growth numbers, although in absolute volume term, you could see very good numbers. So overall, on the demand side, I think it's holding up well. And with the new introductions that we have had, we have seen growth faster than the industry. And as a result, our market share has gone up in this quarter.
Shashank, in some sense, you've been a late entrant into the 7-seater MPV/SUV segment, right? Tell me, what's the feeling about Invicto? Do you think this is the category within urban SUVs where you could actually cash in from the other players and, try and get a bigger size of the market share?
The SUV sector has been growing. In fact, 5 years back, it was just about 22%, now about 47% in this quarter. So very good growth. Maruti Suzuki's market share in Q1 of last year was only 8.5% in SUVs. Now that has grown to, we are now close number two from the position of number 4 last year. We have about 22% share in the SUV segment. That's good because it helps our overall market share, and we have introduced the Vitara, the Chimney, the Fronx, and of course we had the Brezza. So these are the 4 SUVs. And in the MPV segment, we had the XL6 and the Ertiga. We had about 50% share, by the way, last year in MPV segment. But now we have gone into a new price segment. And I think that's the landmark or milestone, you can say, in our journey. Because, earlier Maruti Suzuki was known to have been the market leader in the less than 10 lakh rupee category vehicles, which we still are. We have 60% share there. But 10 to 20 also, we became market leader last year. It's a fact which is not known to many people. We are the market leader in up to 20 lakh category. So as a natural progression, of course, we thought we should get into the 20 lakh segment category. It's about 7-8% of the market at the moment. So volumes may not be high, but it will have a very positive effect on the premium image that, the other brands within our umbrella brand it will have a rub off on.
That's a very interesting point that you made, Shashank. So going forward as well, do you think this is going to be a conscious strategy now to try and position Maruti more within the premium SUV, MPV segment? And can we see more launches even after Invicto in this particular category?
Yeah, I think that's a very common question, and there is still a large portion of our country which has, those traditional criteria of buying, which is value, price, fuel efficiency, low spare parts cost, low after maintenance, cost, and so on. That's something where we are anyway very strong at, and we will continue to dominate. We call that the Bharat, and then there is this new India, which is more aspirational, going away from functionality to more design, technology, features, which is growing, as I just mentioned. And therefore, we also have to participate in this segment. And that's the reason why we created the Nexa channel. And going forward, we are bringing in products which are very high on technology, features, and accordingly, the corresponding prices also are high. So yes, it's a conscious strategy to address both the Bharat and the new India.
So Shashank, our understanding of the market is following that as you go up the value chain, your margins, they tend to increase higher. And that's been demonstrated by your capability. If I look at Grand Vitara and how the margins were higher than Alto. So as you move up the value chain, in 12 to 24 months from now, how much of your new business will come from traditional cars and how much will come from the new car launches or the higher margin products? How should I read into your smile? You're smiling on that question. You're smiling a lot. I mean, looks like we're in for bumper quarter for Maruti again.
No. I'm just trying. I'm thinking how to reply because, it's probably not always correct that a higher price vehicle gives you a higher margin. It actually depends on the competition in that segment. For example, in the SUV, these are a slightly higher price, like mid SUV, but the competition is intense. We have about 45, 46 brands in that segment. Whereas in some other categories, the number of brands are much lower. So it depends on the competition, the relative margins. But you are right, on a thumb rule basis, a higher price vehicle should give a larger margin. However, when you look at the projection, as you are asking, where will Maruti Suzuki be? Currently, we have about 53% of our overall sales coming from hatches, the small cars. Going forward, I think by the end of the year, it should fall to somewhere between 45 to 48%. In other words, the larger cars should gain in our portfolio, maybe from the existing 47% to maybe 55%.
Srivastav, what's the outlook when it comes to your annual production capacity? What does it currently stand at, and where are you looking to, or how much are you looking to grow it by the end of the year over the next few years?
Yeah, so we have actually announced earlier that our current capacity is somewhere between 21 to 22 lakhs, combining Gujarat, Manesar, and Gurgaon. And we'll be adding a 2.5 lakh capacity with our first plant coming up in Kharkhoda in 2025-26. And going forward, of course, Kharkhoda plant by 2030 should have give us an additional capacity of 10 lakh. That means the capacity will go up to 31, 32 lakh. But as we had projected earlier, by 2030, the demand for Maruti Suzuki products, including exports and OEM supplies, should be about 40 lakh. That means that we have to add one more plant, and that's what, in the last board meeting, the board had directed the management to find a new place, a new factory, where we can add another 10 lakh. So by 2030-31, we are looking at that 40 lakh capacity from the current 22 lakhs.
Now, everybody wants to move in the SUV market. You mentioned 40. Well, everybody is trying to get a piece of that space. It is pretty much like 10, 12 years ago what happened in the small car market. Everybody wanted to have a larger share because that was the go-to space, because the cycle wala was buying two-wheeler and the two-wheeler wala was buying small car. Now the difference is that the first car you're buying is actually SUV. Nobody's going up the value chain. But the spirit of my question is that if there is so much of intense competition in the SUV market, could there be a market share fight? Could there be disruptive pricing? Could there be competition where everybody will go for gain, not margins and profitability? Do you see a war happening in the SUV car market in India, led by Maruti?
So it's an interesting question, and we have been, internally debating upon it. We have about 45, 46 brands in the SUV space. Fortunately, the market has been growing very fast. And as a result, and also because in the last 2 years, we have had supply issues, first related to the COVID shutdown, and then the semiconductor crisis, which still persists to some extent. So as a result, the pressure of high production or high supply chasing a smaller demand was not there. And hence, we could see a large number of players in the SUV segment without discounts. In fact, there was waiting for most of the models. Still is for some of the models. So I think going forward, when the supply increases, yes, as is the case always, if you have supply larger than demand, then is the time when stocks start piling up in both in the factory and in the dealer network. And that's the time when, companies adopt different strategies. Some adopt a higher market share chasing strategy. That means to have a larger sales promotion expenses. Others would probably, compromise on market share and look at lower sales promotions. So that depends then on the company. But theoretically, and also what we have seen in the past, if the supply exceeds the demand, you would see discounts go up.
Srivastava, I have to ask that the Invicto means undefeated in Latin. You guys come up with some very innovative names. So what are some of the other interesting names that you're planning for the new launches?
Very, very, very interesting. So we are brushing up our Latin, our Spanish, and our Greek language, because those are the languages which provide us all those exotic names like the Invicto, which comes from the Latin word invictus, which means, as you said, undefeated.
So, Shashank, I have to ask you this. Are you a bike lover at all?
Yeah. Actually now I don't have that. I don't drive it now, but yes, during my college times, yes, that was actually the favorite above the cars also.
So if you had to ride one, which one would it be? The Hero Harley latest bike? Would it still be RE? Or would it be the newest offering from Bajaj?
Hero Harley probably, but I would... I have to examine that and see and compare which one would be more exciting.
I'm sending this interview to Eicher that you're endorsing Hero Harley.
And Mr. Munjal as well. Very happy.
I like to see the specs, and I like to see how my wife looks at it, and that's how.
A test ride soon.
Wife and bikes, okay, that's a new one. Shashank, so nice to have you.
Television, I can't say otherwise.
Well, Shashank, so nice to have you. Thank you for joining us. It's been always great to have you. But in general, if I have to summarize today's interaction, can I say that the second half, as of today, if you have to look at it in terms of the macro picture, you are reasonably confident. all this talk of a rural slowdown, you think that one can dismiss easily, at least from your perspective?
Two red flags: the El Nino effect on the monsoon and the high interest rates. Beyond that, I think current demand parameters, as I said, are holding up well. So you can see large volumes, but not necessarily high growth, because last year the base effect has now come in. And Q2, in fact, was the largest ever in the history of Indian automobile industry last year. So yes, I hope the demand continues, but growth numbers from over last year might be a little muted from now.
That's the base effect. But on the other side, the base effect could kick in, but the base effect would also be helpful because commodity prices have come down. So the base in terms of margin, that has also been made. Can I assume that?
Yeah, absolutely. Yeah, so I was talking only purely from a market perspective. From a financial perspective, of course, what you said is right.
So what is a better scenario? Decently moderating base in terms of top line, but a strong uptick in margin. What is a better scenario for the company?
Listen, I always find that whenever I ask the question internally, the answer given to me is that both are important. I have to pursue volumes and market share, and at the same time make sure that the profitability remains high.
So I'm not putting words in your mouth, but if I'm summarizing today's interaction by saying the headline from Maruti and from Shashank is that the second half of this year for the auto sector and for Maruti per se would be a reasonable one.
Yeah, I think that's a reasonable assessment.
Okay, so now it is bread, butter, lassi and cake. Everything is back on the table for you.
With the cherry on top.
Thank you.
All right, appreciate your time.
Thank you.
Well, for banking sector, it's always been, perfect spread in last 2 years. NPAs are low, credit is strong, things are looking up in terms of margins. But is the best of the pricing behind us? And Dinesh Sharma, fund manager with Nippon India, joins us now. When have we been interacting with you and you've been very bullish on the banking sector per se? My question is that, is this as good as it gets now? While incremental growth will be there, but from a stock market standpoint, is there consensus pricing which is getting built in?
Yeah, so good morning and thanks for having me on the show. So to answer your question, if we were to put it, we would say that we are somewhere in the middle of a good cycle. I think there are some more legs for this cycle to go. Like credit growth seems to be reasonably strong for the next few quarters at least. And if the capex cycle, housing cycle, general economic, macroeconomic scenario remains the way it has been, it can go on longer as well. And to that extent, both growth and credit quality doesn't see any immediate risk from our perspective. Obviously, profitability might be a little bit volatile here and there because of some fluctuations in margins. We have seen that some of the pre-quarter releases that have come have seen a little bit of dip in CASA growth, and that might have an impact on margin. But overall, from a banking sector perspective, I think the most important criteria has always been growth and credit quality. And on both of these factors, we still remain fairly sanguine.
Time to look on the other end, which is that look at companies which look at banks or NBFCs which would benefit from a declining interest rate environment, because banks have benefited because of a rising interest environment. Now things are becoming benign, which is NBFCs would start benefiting. Is it time to look the other way now?
So here I would say, see, there were a lot of mispricing, and there were segments which were very cheap. Maybe 2-3 years back, PSU banks were really cheap. Some of the mid-cap banks and small private banks were really cheap. Some of the NBFCs were really cheap. I think that mispricing in the market is largely over at this point, and one has to be really small sector specific or sub-segment specific or company specific. I won't really want to brush it in just one stroke that NBFCs will tend to do better in a falling interest rate scenario, or the banks will tend to do worse off compared to NBFCs. I think banks still have a decent runway to go. Some of the NBFCs which are doing a good job in either their credit segments or credit quality, they will have some advantage of falling cost of deposits for them. And some of the sub-segments like microfinance are looking fairly strong in terms of cycle. Asset management companies have become cheap on the non-banking side. So it's more really company specific and sub-segment specific in the entire financial sector, rather than, I can't really brush it at one stroke, as I said.
PSU banks are no longer beaten out. They are no longer the whipping boys. They are no longer bombed out names. BOB is up 100% in last 1 year. SBI is up about 25-30%. Ditto for Canara Bank. But if I look at the valuation matrix, price to book, potential of earnings growth, do you think some of the large tier PSU banks still have a way to go before they normalize?
So, if you purely look from a valuation perspective, I think they are close to their long-term averages. And in that sense, as I said earlier, there is not a real cheap segment that we can call out in the market today. But from a historical perspective, we have seen that in a good cycle, credit cycle, PSU banks tend to do well. And some of the segments that are doing really well today, housing, corporate loans are going again. In these segments, PSU banks have some strength. And in a deposit sort of crunch scenario, which could happen in Indian banking system for some time, PSU banks have their own strength because their customer franchise is fairly strong. So if you combine all of this, again, the answer remains broadly similar that while valuations are close to average, we are still in a mid-cycle. And therefore, there could be some more runway to go for a lot of large private sector banks as well as some of the large PSU banks. We remain optimistic on both these segments.
Just in specific then, with the fact that, the merger of the giants HDFC and HDFC Bank valued at a staggering $172 billion, how are you looking at, further value accretion for the joint entity?
So as you know, we really can't comment on individual companies in public. But what I would like to say that if you look at the history of large private sector banks in India and the way they have gained market share and the way they have created value over the last 10-15 years, we still think given this runway available in terms of financial penetration and in terms of credit growth, even though these are some of these private banks have become fairly large today, they still have a good runway to grow in the mid-teens for some time to come. And therefore, just because of size, we won't be very negative on the space as of now.
Vinay, I mean, the pecking order changes now. And I mean, it absolutely amazes me. I'm just going to, establish this point for the benefit of our viewers. Just imagine what a franchise Mr. Parekh and Mr. Puri and others have managed to create. India has now the fourth largest bank in the world. Fourth largest bank in the world, and it has got created exactly in less than 25 years. And 25 years is not once upon a time. And we are talking about banks in America like JP Morgan and Citibank, which have a legacy of decades. This is a bank which has been born in this century and it yet has become the fourth largest bank. Yes, because of HDFC and HDFC Bank, but that is what India is, and that is what we must appreciate, and that is what something I guess markets need to take a standing ovation and bow down to the kind of work KK Mistry, Deepak Parekh, Aditya Puri they've done. When that aside, I'm just bringing this point out that it's such a proud moment for us when we speak as market commentators about the franchise value. When the pecking order changes, SBI becomes number 2 and HDFC Bank becomes number 1. What changes in terms of dynamism? Because banks is all about CASA, reach, brand, scalability, technology, and now it's the balance sheet size. So if the pecking order changes, will this be disruptive for the sector per se?
So not sure on this one, Nikunj, because what we have seen over last few years that if you leave aside the 2015 to 19 era when some of the large banks were involved in their own NPL scenarios and trying to get rid of those past mistakes. But other than that, even the large sized private sector banks and some of the public sector giants have actually been able to grow mid-teens above the system rates consistently. They have gained market share. Not many large banks have actually lost market share over the past 8-10 years, if I can say so. So therefore, even if because of the changes that have happened in banking sector and the large have gone larger, we don't really see a major impact of that on financial sector per se. Obviously, there will be cycles of competition. Some banks will be more competitive in some years, and some banks will be less competitive, and some banks will be more competitive in certain segments, and they have their own strengths and all of that. But would there be a big financial shakedown because some of the entities have become really large, and would there be a big impact that I can envisage? Not really. I don't think a lot will change because of these private banks getting so large, and obviously PSU, some of the large PSU banks.
Okay, so final question. I look at Bajaj Finance numbers, retail-based franchise growing at 32%. I look at SBI corporate book, enviable growth. I look at MSME books, which are dominated by NBFCs, they are also growing. So for next 3 to 5 years, if one has to lean on a financial theme, which financial theme would you like to lean on? Would it be retail? Would it be SME? Would it be insurance? Would it be asset management's making a comeback?
So I would say over the next 3 years might be slightly difficult to answer because a lot of segments are looking good. But if you look from a slightly longer perspective, 5-6 years, I think the non-banking entities look more interesting to me at this point of time, purely in terms of growth and the runway available. Because if you look at penetration of some of the non-banking products in India, that penetration is fairly low. And we have seen, when economy moves from a certain size to a certain size, the sophistication of products increases, and that similar experience should happen in India, and therefore people will buy different sort of financial products, different sort of payment mechanisms, different sort of wealth management products, and therefore purely from a growth perspective, we would be more excited on the non-banking side if you are taking a long-term view of that.
I really appreciate your time. So glad you could join us. Markets, meanwhile, well, what a turn of events. Well, what does a bull market, what happens in a bull market? You start low, you go up. You go up, you stay there. So markets, they started low and then we are climbing above 19,500. And it's a climb which is worrying a lot of small cap fund managers.
But Nikunj, this also is the move that we're seeing. Sorry to interrupt in terms of the up move. In light of the fact that the global market is doing what it's doing, is proving our show of resilience, the fact that we're above the 19,500 mark.
Yeah, so you got to ask yourself, is that A, in relative, and B, absolute. So I think India is outperforming both in absolute and relative, and that's the most fantastic part. That if others are falling, you're falling less. Yeah. That's relative. Others are rising, you are rising more. That's relative. But in an absolute term, when others are falling and you're going up, that's absolute. So in absolute terms, also, I think it's been a fantastic summer 2023 rally. See, you don't have to sell just because markets have gone up. Just for the sake of turning bearish, there is no point in turning bearish. I know it's difficult to keep up with the speed of the market, and if you miss the rally, you would say, okay, the markets are looking toppy, time to get out. No, it does not work this way. Markets can do strange things in the short term. They can remain overbought, they can remain overextended on both the sides, and that's what markets are. But somewhere there is a concern about valuations in the small and the mid cap stocks. And two AMCs have stopped accepting fresh lump sum money, not SIPs, into small cap schemes. Is this a good strategy, considering that mutual funds are meant to manage money for 3 to 5 years? And isn't this market timing for a product which is centered around no product timing, market timing, and sticking to long term? Is it a good idea to ban even lump sum? Sanjay Shah, Managing Director of Prudent Corp, joins us now. Sanjay, good morning. Thank you for joining us. Logically makes sense. Risk reward ratio is not favorable. Don't buy lump sum. But if I'd extend the timeline, and for somebody who wants to buy lump sum and say that I have a 3 to 5 year time frame or 5 year beyond, why should mutual funds say no?
No, I think logically you are right, Nikunj bhai, but if you look at historically, people always try to chase the return. And if you look at currently the 1 year return and 3 year returns of small cap category has been upward of 30%. And the incrementally in the first quarter of current year, we have been seeing that a lot of money is coming into small cap category. And that shows the reason that people has been coming with a lump sum money only because you look at the return. So the view from a 5 year perspective of investing in small cap is still very constructive. But if they are saying that no, we don't want to take the lump sum money of 50 lakhs and 1 crore, but you continue to invest through SIP of 5 lakh rupees through, because if you look at Reliance, they have said that up to 5 lakh rupees per PAN, they can take the SIP. So I think that's a very, constructive way of taking money into a small cap category, which otherwise has a lower liquidity and it's normally very, very volatile. So if you look at, we have seen that in March 20, the fall in small cap category was very, very intense. It took a lot of time to recovery, but once it recovered, I think it has given a very good return. So from a retail point of view, because we manage the retail assets of the Indian investors, we believe that investing in small cap through SIP route is a very, very good way of investing. So we are very, very constructive, but if they are not taking money through lump sum, I think it's a very, very constructive way of saying no.
stay on with us. I just want to also address the listing of the day, that you can see the visuals at the side of your screen, and going by the kind of buzz that it generated with respect to the kind of subscription figures, the grey market premium, I don't think it comes as a huge surprise that it is going to be perhaps a bumper listing that is for Idea Forge Tech. Remember, the drone manufacturing company makes its debut, and let's just see where it lists at, about 1329. Do remember the issue price was about 672 rupees per share. So that is a stellar listing as of now for Idea Forge Tech. Do remember that you did see the qualified institutional investors, which were at the forefront. They had bought close to 125.8 times in their reserve portion, retail net worths, HNIs, etc. You did see also pretty strong subscription figures from there. We will be connecting with the management of Idea Forge Tech in just a short while, but that's a bumper listing for sure. Just to get right back then to our discussion, and Sanjay, I wanted to understand your views, because clearly we had seen from the month of March, there was a lot of momentum and a lot of fervor within a lot of these small cap funds. Do you think that now we are seeing valuations perhaps tilting towards the higher side?
So if you look at the, I think the market cap of small cap in the overall market cap, I think it is inching towards 15%. So the normal band of small cap contributing to a total market cap is normally between 10 to 17%. So probably we may not be cheap in the overall market cap, but we are definitely going to a fair value zone. So what I'm just trying to say is that for a retail guy or somebody who's coming to a mutual fund, I think timing by way of valuation would be very, very difficult. So I think we sincerely suggest retail guys to continue to invest in small cap through SIP, because I think virtually we believe that still the category offer a lot of value, but you should not do a lump sum at this point of time.
Some in large cap, because large cap stocks have also seen a 15% run up. ऐसा नहीं है वो नहीं चले.
No, that is a call on the overall market. So I think probably I think the investors should look at nothing less than 3 to 5 years from the point of investment perspective.
My other big question is that while last 1 year, because of this, thankfully because of the move which has happened in last 6 months, are looking strong. But if I really go beyond 3 years, 5 years, it goes back to that same question, which is, why are mutual funds underperforming their benchmark? How long will that continue? And should one really not go for direct plan when I have to buy index only? Good old debate, we've discussed it, debated it, but it's like saying, subah ki chai, roz debate karo. We can talk about it.
So I think that is again probably when we are saying that investors are chasing return, I think the important role is always played by the advisor to make sure that he should not buy only because of the return, and they invest through I think SIP route, they invest from a leg. So I think probably you just need to make sure that the kind of value which advisor add by managing the emotion is so significantly larger that this 1 or 2% of difference doesn't make huge difference, frankly. And that has been proven globally also. Forget about the Indian market. That advisor plays a huge role in managing the emotions. So that's why I'll just give you, let's say, example of Prudent. Today we have a 550 crore of SIP book. Within that we have almost 18% money coming in small cap through SIP. So my monthly SIP book is of about 80 crore. So that shows that we also advocate investing in SIP. But let us look at the SIP from a small cap through a SIP route. And that is the important value which advisor has to add, sir.
Sanjay, before we wrap it up, let's look at time frame. Next 6 months, very short term. Which to your mind is the best category? Next 3 years, which could be a best category stroke a mutual fund, hybrid variety? And 5 years plus. So 3 months, 3 years, 5 years plus. If somebody is watching the show and if they want to benefit from your advice, what would you advise?
Sir, anything less than 1 year in the current situation has to go into a liquid fund, because it's very, very difficult for somebody to say what will happen in the next 1 year. For 3 years, we still are very, very constructive on the large cap and the balance advantage category, which is a hybrid category, which goes on making allocation in the both the asset class, debt and equity based on the market parameters. So from a 3-year perspective, large cap and the probably asset allocation category, multi-asset allocation category, balance advantage category. From a 5 and 7 years point of view, we are still very, very constructive on the mid cap and the small cap, apart from balance advantage category for sure.
Thank you for taking time out and joining in and giving us a sense as to what the outlook is when it comes to those small cap funds. Well, for now, that latest listing, Idea Forge, that continues to remain on the radar, a stellar one at that, given that the issue price was close to 672. But other than that, just quickly marking some of the stocks that are buzzing in an otherwise pretty lackluster day of trade. You've got something like a Suntech or Responsive Industries. Titan continues to prove its might. Operational updates have been strong. A PVR Inox on the gainers radar, and Strides Pharma, it's been an stock that has been in the spotlight above the 450 mark. But moving right on, let's also understand what the impact of the rising inflation is going to be, the hike in tomato prices, etc. for restaurants. Are they going to resort to further price hikes as well? We've got Anurag Kataria, President NRAI, now joining in. Anurag, good to have you on board. Avan this side. Just wanted to understand what the impact is, given that there has been a phenomenal rise in the price of spices as well as vegetables. On the industry as a whole, do you think you will have to resort to a menu price hike?
So I first of all, thank you for having me here. No, in the immediate terms, I don't see any price revision in the organized sector. Simple reason being that we all have annual rate contracts for our supplies and they hold good. But however, having said that, if this buoyancy in the prices, they keep going for a little longer period, say a month or so, I'm sure the supplier are going to come back and renegotiate because it will become unviable for them after a while. And in such a case, of course, I mean, if we have to absorb higher costs, then if the input cost is going to go up, we will definitely be compelled to hike the prices. But for now, I don't see that as a problem under the current circumstances. It's still very early days.
Fair enough. But do you think that, in your experience, that this kind of a price spike that we're seeing, especially at a time of this monsoon, is just perhaps seasonal in nature, that prices will come off in the next, say, few weeks?
I do hope so, because we have seen these kind of trends year on year. Every year, one commodity price will suddenly go up. You had onion issues once, you had dhania patta issue once. Now you have tomato. I think these are seasonal vagaries because, our agriculture is still very dependent on the rains, and any fluctuation in that causes this. I would like to believe it's a short-term problem and it will get resolved ultimately. And these things will continue to happen, if you ask me honestly. Every year, something or the other will go up. But as long as it's temporary, it's only because of an extraordinary factor, I don't see much of a worry there.
Right. But the problem, I guess, Anurag, purely from a consumer point of view is, restaurants already have taken massive price hikes in the last 12 months and none of it ever gets rolled back, right? There's always, like you mentioned, some or the other commodity which is leading to the inflation in food prices, and that continues to weigh in on, the businesses as well. For instance, we saw the latest data coming in from Zomato. And it's quite intriguing that the average ticket prices or average order value of orders is just about 250 rupees or so. So I guess that is where consumers get a little bit more conscious, right? And in the overall scheme of things, that's going to weigh heavy on the restaurant businesses as well.
So first of all, I don't see that the price hike has been quite substantial over 1 year. There had been a few things. I think if my memory serves me right, two factors were huge. One was the oil price increase, and second was a temporary hike in the gasoline prices. And that is where we had increased the prices a bit. But beyond that, nothing. As far as average order value goes, that is more than the price. I think it's also about conversion. If you're ordering for more people, and I don't know if from what I recollect, the average order value of Zomato was $4.50 when I saw last. Maybe it has come down. I don't know what is the issue, but that's more to do with the eating patterns and the consumption patterns than the price really.
My next question is again back to the theme: what's happening to spices? What's happening to tomato prices? So next time when I go to a restaurant, should I not expect a makhni gravy? It'll be less tomato. It'll be more something else. I mean, it's getting to that. Restaurants will be forced to cut the corners.
No, not at all. Not at all. I think every restaurateur worth his salt knows if you compromise on your product quality, there is nothing left to save. I would rather cut my margins or hike my prices, but reduce my quality of the gravy. I think it's a temporary phenomenon. As I said earlier, most of the organized sector restaurants have annual rate contracts, so they are not directly impacted as of now. However, if these tomato prices keep to where they are for another month or so, I'm sure all our suppliers are going to come back and renegotiate. At that point of time, you may have a little bit of price hike, perhaps. But until then, I don't see your makhni gravy changing at all.
Anurag, it's been a rather tumultuous moment for the restaurant industry. First, it was vegetable inflation, then it was oil inflation, now spices inflation. At what point in time do you think the whole price hike versus acceptability, that equation will not adjust itself? You know, right now the consumer is happy to pay the price hike, and restaurants have been forced to take a price hike because raw material prices have gone higher. But there would be a point in time where inflation or the price hike will not be accepted.
No, you are right. But I think our consumers are very intelligent, and whatever we use in the restaurant, they use it in their households every day. So they are fully aware of the inflationary pressures whenever it comes on a certain product or a product category, so to say. But you are right. At certain point of time, if things become very unviable, right now I don't see that. Overall inflation seems to be under control. It's only a few things that are hitting skyrocket. That should not really bother a customer. But if overall inflation goes to some crazy levels, as we are seeing in some other countries, then obviously there will be a drop in consumption, because there is only a certain amount of elasticity in what the consumer can pay. After a certain while, it becomes unviable for them. Either the frequency will go down of going out, or what they consume will reduce.
This is about the ONDC rollout. What has been your experience as president of NRAI in terms of the ONDC rollout?
Let me first correct. I'm not the president of NRAI anymore. I'm a trustee on the board of NRAI. I was the president. ONDC, I think, is a great new avenue. It's a great new avenue for online commerce. It is creating one more channel for the restaurants. I don't think it is going to be a challenge to the current aggregators, but it's in the immediate term. But it's an additional channel for e-commerce for restaurants at a very affordable price. And more than affordability, I think it is doing what every restaurant here, especially NRAI, has been asking for, which is to unbundle the service. And it is leaving lots of data with the restaurants, which is not the case with aggregators. So I think it's a step in the right direction, early steps. In fact, we are engaging with the ONDC very closely. I think we have another meeting lined up next week. I think on the 17th, if my memory serves me right, with the ONDC officials. So hopefully this is a step in the right direction, and it's firming up well.
Great to have you on the show. Thank you so much for taking the time out and speaking with us. Whether this spike that you're seeing in vegetable as well as spices, how is that likely to impact the restaurant industry? What's the market then up to? We have already recovered most of our morning losses. We already made it to that 19,506 print. So in point-wise, we've already clocked a fresh high for ourselves, by the way. What's holding out in trade? Titan, M&M, Reliance. They are the ones which are doing the magic for the index. But on the way down, there's Nestle, Cipla, Britannia, ICICI Bank, Bajaj Finance. They're the ones which are pushing down as we speak. We'll take a very quick break, come right back. Lots more lined up on the other side.